Now, what is the accounting procedure we have to follow when a partner retires? Why will a partner retire? Time pass. No, he has become old. He has become tired. And he wants to retire. He wants to give some family time. So he wants to retire because of old age or Padadleru. He and the other partners are not on good terms. So they have some ego problems. They are not able to work together. So one of the partner decides to retire. Or due to ill health, one of the partner wants to retire. Or simply he has lost his motivation to continue in the business. There can be various reasons. This is not Partnership Act class. It's Partnership Accounting class. So let us not discuss the various situations in which a partner may retire. But we have to learn accounting for retirement of a partner. Okay. What are the steps to be performed? Step 1. Revaluation of assets and liabilities. Step 2. Calculation of goodwill, valuation of goodwill and treatment of goodwill. Valuation of goodwill and its treatment. Third step. If there are any accumulated profits or if there are any accumulated losses in the balance sheet, they have to be shared among all partners. All partners, including the partner who is retiring. Because those profits have been built out of my hard work, boss, so I want my share. They would ask the firm to distribute the entire reserve so that he will get his share. Revaluation also for the same purpose. He knows that he has invested money for 10 long years, value of assets has increased, so he doesn't want to leave those profits for the remaining partners. He will say, revalue the assets, if there are any profits, share it. All of three of us will share it. I will get my share. Because I am going, you will give me money and send me. Remaining profits, when you sell the asset, you can realize and enjoy. So, revaluation of assets and liabilities. Second, valuation of goodwill, treatment of goodwill. Third, sharing of accumulated profits, accumulated losses if any. Step 4, preparation of cash and bank account, preparation of partners, capital and current accounts. Now, when you prepare the capital account of the retiring partner, you will find that his account is credited with the opening capital in the balance sheet. His capital account is credited with some share of goodwill. His capital account is credited with share in revaluation profits. His capital account is credited with share in reserves. His capital account may be credited with some other items also. Then his capital account is debited with his drawings. If he has taken some assets, his account will be debited with that. Now once you prepare the capital account, you come to know how much has to be paid to the retiring partner for settlement. So how much you have to pay to him to settle his account. Once you know that, then the question comes, how will you discharge the liability? Write a check, settle his account completely by giving the installment in one go. Normally that will not happen. If it's possible, if the firm is so prosperous, if it is having so much cash balance, why will this guy retire? Practically it may not be the case. Yes, or the other partners have to pump in cash and then they will give a check to the retiring partner. Or the firm may do one more thing. They may take a new partner, ask him to bring capital. With that capital, send this old man out of the firm. So either you write a check, pay the amount in lump sum, settle his account, or transfer the amount into a loan account and settle it gradually in the form of installments along with some interest. That is the way you are going to settle it. Then you have to prepare the balance sheet after retirement of the partner. Same steps. You write down. Valuation of goodwill same. No change at all. Treatment of goodwill. Write down. Same story again applies. Retirement of a partner. Raise goodwill in old ratio. Write off goodwill in new profit sharing ratio. That's it. Write off. Treatment of goodwill will only apply memorandum revaluation method. Will only apply memorandum revaluation method. Remember, memorandum revaluation method. Raise goodwill in old profit sharing ratio. Write off goodwill in new profit sharing ratio. Write down. 1. When goodwill is raised, when goodwill is raised, what is entry you write? Goodwill account debtor, goodwill account debtor, goodwill of the firm, goodwill account debtor, goodwill of the firm, to all partners capital account credit, or will say existing partners capital account credit in old profit sharing ratio, to existing partners capital account credit, existing partners capital account credit, old profit sharing ratio. Here existing partners means it includes the retiring partners. Existing partners, write down. Existing partner means all the partners including the retiring partner. All partners doesn't mean all partners after retirement. It is all partners before retirement. Okay, next entry, when goodwill is written off. When goodwill is written off, when goodwill is written off, what is the entry you write? Existing partners capital account debtor to goodwill account. Not existing. Write down. Remaining partners capital account debtor. Remaining partners capital account debtor. Remaining partners capital account debtor to goodwill account. Remaining partners capital account debtor to goodwill account. Who are remaining partners? Partners remaining after retirement of a partner. Okay. Sometimes in remaining partner you can have a new partner who has been admitted. He will also become a part of this remaining partner. Write down. Remaining partner means partners remaining after retirement. Sometimes it may include a new partner who has been admitted. Remaining partner means partners remaining after retirement. Sometimes it may include. Sometimes it may include. Sometimes it may include. Sometimes it may include a new partner who has been admitted. In new profit sharing ratio. Okay. Next. You write next. Next you write. The same effect as above. The same effect as above can be given without involving goodwill account. Write down. The same effect as above can be given without involving goodwill account. Shravan, tell me the entry. No, I will not leave you. You have to tell me the entry now. Are you Shravan?
Remaining partners capital account.
What?
Remaining partners capital account. Gaining partners capital.
Write down. Gaining partners capital account debtor. Gaining partners capital account debtor. Gaining partners capital account debtor. 2. Sacrificing partners capital account credit. Sacrificing, you write. sacrificing, you can have a retiring partner and the remaining partner also sometimes. On adjustment of ratios, you will find that not only the partner who is retiring is sacrificing, another partner is also retiring, whereas other partners are gaining everything. So gaining partners capital account letter to sacrificing partners capital account credit. Below that entry you write how much amount should be debited, how much amount should be credited. Write down. Gaining partners capital account should be debited with central formula bhul ja tu. Gaining partners capital account should be debited with their share, their gain in goodwill. Gaining partners capital account should be debited with their gain in goodwill. What is that? How do you calculate that? You write goodwill of the firm into fraction of the goodwill gained. Fraction of the goodwill gained. Suppose I have gained 1/10. Value of the goodwill of the firm is 1 lakh. Then I will say 1 lakh. In this I have gained 1/10. 1 by 10. 10,000 should be debited to my account. Okay. Next. Sacrificing partners capital account should be credited with their gain in their sacrifice in goodwill. Sacrificing partners capital account should be credited with their sacrifice in goodwill. How do you calculate that? Goodwill of the firm into fraction of sacrifice. Let us do few problems. Come to problem number 2, page number 18.5. Problem number 2, page number 18.5. A, B, C are partners sharing profits and losses in the ratio of 3:2:1. Following is their balance sheet as at 31st March 2008. Assets: plant and machinery, stock, debtors, cash and bank balances. Capital ABC and creditors. B retires from the business owing to illness from 1st April 2008. Following was agreed upon retirement of B. Goodwill of the firm has been valued at rupees 3 lakh. But no goodwill account is to be raised in the books. Plant and machinery has been revalued at rupees 6 lakh and stock revalued at rupees 1,80,000. A sum of rupees 30,000 out of debtors was agreed to be bad and was to be written off. A and C will continue to carry on the business and shall share profits and losses equally in the future. Amount payable to B shall remain in the business as loan carrying interest at the rate of 18% per annum. You are required to give journal entries to give effect to the above. Now we are not kids to write journal entries. We are masters of the journal entries, hence we are not going to write journal entries. To prepare revaluation account and to prepare opening balance sheet of A and C as at 1st April 2008, when changes in assets and liabilities are to be brought into books, that means after revaluation you want to show revalued figures in the balance sheet. 2. When changes in assets and liabilities are not to be brought into books, that means you cannot show the revalued amount in the balance sheet, you have to follow memorandum. Now, normal revaluation you all know. Let us go for the B bit. So we will prepare memorandum, revaluation account. We are not going to show the changed values in the balance sheet. Okay, remaining all accounts will remain the same. Start. How will we start? Tell me the flow of accounts. First, memorandum revaluation account. In memorandum revaluation account, first part is revaluation, second part is reversal. First part is revaluation, second part is reversal of revaluation. Then, do you need to prepare goodwill account in this problem? No, actually you have to give the adjustment through the capital accounts of the partner. So omit goodwill account. But see the balance sheet. Do you have any reserves in the balance sheet? No. If there were reserves, you have to open reserves account. Then you can go to cash and bank account, partners capital account, and then balance sheet after retirement. Let's be quick. Yes, you have to prepare loan account also. Who are the three partners? Please tell me.
ABC.
Who is the retiring partner? B's loan account also open. Tomorrow's class on retirement will be very important. Ready everyone? Always start with opening balances. Cash and bank balances 2 lakh. Brought down 2 lakh. Partners capital account brought down 4 lakh. Tell me the numbers.
3 lakhs, 2 lakhs.
Santosh is alive today. B retires from the business owing to illness from 1st April 2008. Following was agreed upon retirement of B. 1. Goodwill of the firm has been valued at 3 lakh, but no goodwill account is to be raised in the books. Okay. Please tell me what was the old profit sharing ratio between ABC? 3:2:1. And see point number 4. A and C will continue to carry on the business and shall share profits and losses equally in the future. If you want to know who is the sacrificing partner and who is the gaining partner, working notes, write down. B is retiring. B is retiring. He is sacrificing 1/6 share in the profits. Not 1/6, sorry, 2/6 share in profits. 3:2:1 now, current ratio. B is sacrificing, he is leaving 2/6 share for the remaining partners. 2/6 share. See, after I retire, I cannot ask a share now. So the remaining partners are going to take your share. 2/6, you will say. Next, gaining ratio of A and C. Gaining ratio of A and C. Gaining ratio of A and C. Gaining ratio of A. See, if you want, you can follow the same formula we learned. Old ratio minus new ratio. Don't change the formula. Answer will appear in negative. That means gain. No sir, I was taught old, new ratio minus old ratio. Whatever you want to do, you do. But you should understand what you are doing. Gaining ratio of A. I will do old minus new only. What was his old ratio? 3/6. Now it was decided new ratio is 1/2 equally. Okay. Earlier out of 6 parts he was getting 3 parts. Now he is getting half of the share. So 3/6 is 1/2 minus 1/2 0. He has not gained anything. Not B. C. Gaining ratio of C. Old ratio 1 by 6 minus 1 by 2. 1 by 6 minus 1 by 2. How will you make this 2 equal to 6? Into 3 into 3. 1 by 6 minus 3 by 6 minus 2 by 6. This is gain. This is gain. Minus 2 by 6, or you can say 1 by 3. Gain. C has gained 1 by 3. B has sacrificed how much? 2 by 6, which is nothing but 1 by 3. B sacrificed 1 by 3, which was gobbled up by Mr. C. He has taken that 1 by 3. Whatever he is losing, he says, I want that stake. Okay, A says, okay, you take it. Are you able to understand? Now write down entry for goodwill. Who is the gaining partner now?
C.
Only C. You write C capital account debtor. I gave you a specific formula. C capital account debtor. What is the goodwill of the firm? 3 lakh into his fraction of gain. What is his fraction of gain? 1 by 3. 3 lakh into 1 by 3. 1 lakh. C's capital account debtor 3 lakh into 1 by 3, 1 lakh. 2. B capital account credit, sacrificing partner. B capital account credit. Again, use the formula. 3 lakh into my sacrifice 1 by 3, 1 lakh. Entry should tally. Is it tally?
Yes, sir.
Give posting. I have credited B, I have debited C. I have debited C, credited B. Plant and machinery has been revalued at rupees 6 lakh. See the balance sheet value? Balance sheet value is 4 lakh. But now we are deciding to revalue it at 6 lakh. So we have to increase the value to You have to increase the value by 2 lakh. Profit. What is the entry you pass when there is a profit? Plant and machinery account, debtor to revaluation account. By plant and machinery, 2 lakh. Then what do you do immediately? Reverse the revaluation. We'll write on the debit side. To plant and machinery. Now tell me how much will appear here, plant and machinery? 4 lakhs. You pass an entry initially, plant and machinery account, debtor to revaluation. Memorandum revaluation. Then you immediately pass an entry, memorandum revaluation account or to plant and machinery. The revaluation was cancelled. Same value remains, book value. No change. Stock. Book value is 2 lakh. Revalued amount is 1,80,000. So we have to revalue stock down by 20,000. So revalue stock down by 20,000. Memorandum revaluation account debtor to stock account. How much? 20,000. Immediately cancels the revaluation. Buy stock. Balance sheet stock 2 lakh. Next, a sum of rupees 30,000 out of debtors was agreed to be bad and was to be written off. Now you have to reduce 30,000 from debtors. Memorandum revaluation account debtor to debtors account. How much? 30,000. Then again on the credit side, immediately buy debtors 30,000. Debtors, tell me the book value.
2 lakhs.
A and C will continue to carry on the business and share profits loss equally in future. So that is a new profit sharing ratio 1:1. Amount payable to B shall remain in the business loan carrying interest at the rate of 18% per annum. So it will remain as a business loan carrying interest at the rate of 18% per annum. Let us close the account one by one now. Tell me how much is left in the memorandum revaluation account. 2 lakh minus 50,000. 1,50,000. To A's capital, to B's capital, to C's capital. Old ratio 3:2:1. Am I correct? 75,
Yes, sir.
50 and 25. By memorandum revaluation. Next. Now let us close memorandum revaluation account. The reversal part now. Now you have a loss. 2 lakh minus 50,000. 1,50,000. Now we have a loss by A and only by C. 1:1. 75,000 and 75,000. First part all the partners. Second part only the remaining partners. First part all the partners. Second part only the remaining partners. Did you give posting? Now try to calculate what is due to Mr. B. How much is due to Mr. B? Please tell me. 1 plus 3 plus 5. 4,50,000. There is no debit. To B's loan account. Transfer the amount to B's loan account. B's loan account will write by B's capital. 4,50,000. We have passed an entry. B's capital account debtor to B's loan account. Capital account is debited, loan account is credited. Calculate the closing capitals of A and C. Carry it down. 475 minus 75, 4 lakh. Nil in B's capital account, C capital account, 4 lakh. 25,000 credit. 2,50,000 is the closing balance. Sorry, sir. 225. Only 50,000 is the balance. Write down the capital. Loan account also you close. Carry it down. 4,50,000. Cash account, no transactions. Carry it down 2 lakh. Now show the items in the balance sheet. A's capital 4 lakh. B's capital, B doesn't remain as a partner at all. C's capital 50,000. B's loan 4,50,000. B's loan 4,50,000. Creditors 1 lakh. No change in creditors. Cash and bank 2 lakh. See whether the balance sheet is tallying. How much? Problem number 3.